let's start this panel, which is on the beginner's guide on how to build a bond portfolio. So let's start with the first question. हम सब ने सुना है म्यूचुअल फंड सही है, तो क्या बॉन्ड सही है? और अगर सही है तो कौन सा वाला सही है?
Good evening, everyone. I know you are waiting for Gaurav Gupta, but I think for next half an hour you'll need to be here with Anshul Gupta. So let's. I think it's a very good question, and this question gets asked a lot of times. My equity is generating 20% returns. Why is there a need to add? Hello, is it better? Yeah. I mean, it's a good question, and this question comes often that if equity is giving me 20% return, why the hell should I have any exposure to FDs, gold, bond, etc.? See, I think like personal finance is pretty personal, so there is nothing right or wrong about it. But the way I look at my portfolio is when you're building a portfolio, you are creating a thali for yourself. Like when you go to a buffet, you don't just have one dish. You don't say कि मैं आज खाली दाल ही खाऊंगा. You say कि I'll have some roti, I'll have some rice, I'll have some dal, etc. So in a similar way, when you're building a personal finance portfolio, you're building a thali for yourself. And thali mein roti, dal, chawal are staple. Similarly, in personal finance, commodities, fixed income, and equity. These are core asset classes in which all the investors should have some allocation. One can say that whether equity should be 80%, 60%, 10%, depending on risk appetite. But I think some allocation to gold, some allocation to fixed income. Within fixed income, bonds is obviously a good choice. And obviously for long-term goals, equity should be there. So yeah, that's how I look at portfolio construction. All the investors should have some allocation to fixed income. The more conservative you are, the higher should be the allocation towards fixed income. All the short and medium term goals should be met with fixed income because fixed income by definition is least volatile. Equity can go up and down. So you should definitely not park your emergency funds, short term goals in a volatile asset class like gold or equity. Fixed income instruments are a great allocation product for short and medium term goals. Now, within fixed income, you have FDs, bonds, etc. While FDs are a great product from a risk perspective, the issue is like most of the bank FDs in India are giving like 7 to 9%. For people who are in 20%, 30% tax bracket, the post-tax returns are around like 5 to 6%. And inflation in India tends to be like higher than that. So net of inflation, you actually end up losing some money if all your allocation is in FD within fixed income. So to generate some alpha, some return, some real return, some allocation within fixed income has to be in slightly higher yielding products. And that's where bonds beautifully fit in. They give you returns which are 2%, 2.5% higher than FDs with a moderate risk.
Right. So the next question I have is, anyone can you answer, Irfan or Anshul, both of you. So debt mutual funds offer a much simplified way of investing in bonds, right? So why should, on the first place, anyone should invest in direct bonds, take all the risk, instead of directly going and investing in a debt mutual fund or a high yield FDs? What do you have to say on that?
So yeah, I think first of all, touching upon the previous question, once we are sure about what kind of fixed asset allocation we need to go for, which is for fixed income. Within fixed income, there are multiple other products, including mutual funds, direct bonds, FDs, so on and so forth. Then it is also to do with what kind of risk appetite you have, right? And of course, your goals, which are mapped to immediate, near term, mid term, and then long term, and then your risk appetite mapped to the proceeds that you are expecting from these instruments can be mapped towards that. Now, coming to your question of debt mutual funds versus, say, a bond, today, thanks to the taxation that stands today, the both the instruments stand on the same footing. It's a level playing field largely for say debt mutual fund and a bond. But if you look at the construct of a debt mutual fund that we generally see on the street, it is largely comprised of relatively lower risk, which means lower return as well from the investor's perspective. However, if you look at the corporate bond portfolio or a corporate bond market as such, it right from an investment grade bond, which is like triple B minus till triple A, and then including G-Sec, etc. You have variety of options to invest in. Of course, these are not like to like, but if you have the appetite, Anshul talked about investing in bonds right in the beginning as well. If you have a portfolio and you have the risk appetite, and the goal is matching a particular risk appetite on the time horizon, you could probably take a risk in a relatively higher return yielding bond versus a debt mutual fund. So yes, debt mutual fund definitely offers a bouquet, and then the risk is diversified. But depending on the personal choice, personal finance goals of an individual or investor, one can go for a bond here, and then there is definitely a delta there, including not now that the taxation benefits are consistent across these two asset classes. Right? Yeah. One point with respect to to make it more real, if you are looking at from a perspective of a senior citizen, one who has a risk appetite which is relatively lesser, so one can go for a lower yielding kind of a bond. And there are bonds which are independently available also. Both of us represent an online bonds platform. We represent Aspero, and these platforms do offer that kind of options to invest in, say, AAA, which is also available as a bouquet from a mutual funds perspective. So you can directly do that, and because if you are convinced with the risk of the bond, which is depicted by the credit rating of the underlying issuer, so there you could probably earn the delta, including the management fee that is not going there, but you can enjoy that as well. So a quick answer to that.
Yeah, just to add to what Irfan was saying, see, I think within fixed income, we have broadly three options. One is FDs, which are giving 7 to 9% risk, 7 to 9% return. State Bank of India FD will give 7%, while a small finance bank FD, which up to 5 lakh is still government guaranteed, will give you 9% returns. Then there are debt mutual funds. So if you look at the returns that debt mutual funds in India are generating, post-expense ratio, they have been somewhere around 7.5 to 8%. So these are at par with bank FDs only. In fact, some bank FDs may give 0.5% higher only, the smaller bank ones. So as a retail investor, it's FD is a better choice. मैं debt mutual fund में क्यों डालूं, जहाँ पे return FD जितना ही है या maybe 0.5% कम है. FDs are liquid, which means by paying 1%, 2% penalty, I can withdraw my money at instantly. Debt mutual fund में there is mark-to-market risk. If the interest rate cycle in India increases, there will be MTM losses as well. तो हो सकता है कि 7.5 की जगह I may get 6%. Or if the cycle reverses, I may get 8.5%. So returns are not like truly fixed in that sense. So I think from a retail investor's point of view, a bank FD of a medium-sized bank or a small finance bank makes much more sense than a debt mutual fund. Things become slightly interesting in the bond market because a lot of good bonds issued by even A category entities are giving returns around 10 to 11.5%. And now after this recent SEBI regulation, bonds are available at ticket size as low as 1,000 rupees. And the buying experience is pretty smooth, like how you log into your Amazon account, add the product you want to buy and check out and make the payment. Similar experience is now offered on SEBI regulated bond platforms that with the ticket size as low as 1,000 rupees, 10,000 rupees, you can invest in a good quality bond, which earlier was available only to ultra HNIs, family offices, institutions. So that was, I think, the bond market is getting democratized. Bond as a product which was available only to HNIs is now available at a very low ticket size and with a very smooth buying experience. So my suggestion to anyone is like, if you're new to the bond market, start small. Like take baby steps. Don't have too much allocation. Maybe start with 1,000 rupees, 10,000 rupees. Understand the product. Get yourself educated. Only once you are completely aware about the product, then start increasing allocation in your portfolio. And another important thing is always diversify. Don't put all your eggs in one basket, which means if you, let's say, want to invest 1 lakh rupee, invest over a period of time and invest across at least 5 to 10 different bonds so that the risk gets like significantly diversified.
Sure. So with that, we now open the floor for question answers. So from the audience, if anyone has any questions, so yeah, please, someone raise their hands there. Please hand over the mic.
Hi everyone, good morning. Good evening, sorry. So my name is Paritosh and I just wanted to ask that we have seen a 2008 crash where the AAA bonds got defaulted and the housing bubble got burst. So do you think that there's something in India also like no one is highlighting or something like that which is ambiguous or there's some ambiguity in that? So what do you think about that? And also, do investors have to keep this point in mind before investing in these type of bonds also?
Good question. So one thing I want to like make very clear, bond is not a risk-free product. A government of bond is risk-free. A bank FD up to 5 lakh is risk-free. But bond carries some amount of risk. Depending on who the company is, what's the structure, what's the tenor, there is some amount of risk. Now, the following question will be, okay, risk kitna hai? How much is the risk then? So if you look at the historical data, investment grade rated bond, there is a 2-year percent probability of default of an investment grade rated bond that it will default. So risk hai, but aisa nahi hai ki it's a 50-50 chance. Going by the historical data, 98% times the bonds will repay on time. 1 to 2 out of 100 cases, there is a chance that there can be a stress in the investment. So for example, in 2008, it was a black swan event wherein globally all the asset classes saw correction. Equity be 70% gira tha, and other asset classes also, investors faced some loss. So if a bond is giving 10%, 11% kind of returns, it is coming with moderate amount of risk. It's not a risk-free instrument. So one should never park your emergency funds in bonds. Uske liye FD hi hai. The idea is that bond should be an addition to in your fixed income allocation, so that net your fixed income portfolio is beating inflation. क्योंकि अगर खाली FD में होगा तो guaranteed 1% loss है in real terms, net of inflation and net of taxes. But if you add bonds and have a decent allocation, your fixed income portfolio will end up generating 1 to 2% real returns post taxes and post inflation. Having said that, don't go overboard. Like I said, start small, understand the product more, and always diversify.
We have a question. Please hand over the mic to him.
Hi, good evening. So my question was related to the reinvestment risk that is very much prevalent in bond market. And as India is a developing country, which we are in the phase of developing, so the interest rates are going to decline, what we see in most of the developed countries. So for planning their retirement portfolios or, as a part of the personal finance, how much and what tenure should be taken into consideration for getting into bond market?
So the point that you called out on reinvestment risks is pretty much real. So, and then the interest rate outlook, everyone has a view. It will go down, it may come up. So I think one needs to have a view on the interest rates and the outlook there. Regarding betting the bond portfolio or the proportion of it, how much should go there, and it's like completely depending on the individual and where the individual is coming from versus the goals that we talked about. And then what kind of risk appetite that goal can afford, right? If I'm planning to go to a holiday to Europe and then I want to bet it against bonds, I think that is not a great strategy. But it is about planning, buying a house, anything that you could do associated with bond portfolio, which are fairly predictable, subject to the risk that we discussed about, we can plan it. But then putting a particular percentage to bond portfolio investment, I think it will be very specific to that individual and then the goal that one is talking about. So that's my answer to that. There was a other question that you have.
Yeah, I was so if I like I am 30 and I want to plan my retirement and put some portion of fixed income securities into my portfolio. So should I go for say like use the volatility in the modern market to utilize this asset class?
So there is very clear duration risk that one can take today. GSEC also offers that kind of. Today there are SBA perps, right? Bank issued perp bonds that are available. One can take a call on that, wherein depending on the interest rate movements, one can also benefit on the profits that one can book on the bond portfolio. So, like I said, there are such bonds which offer that kind of duration. But largely, if you look at the corporate bond market, you will see greater availability in about 18-24 months, which is a sweet spot. But then there are other set of bonds that are available in a relatively longer duration also. But definitely this bond market will deepen as you mentioned, and we will have more options as we go in terms of longer term investment options as well.
I'll just add one thing here to what Irfan was saying. So I think your question is, let's say 20 years back, bank FDs used to give 10%, 11%, and inflation used to be 8, 9%. Now today, bank FDs are giving 7%. Inflation is, let's say, 5, 6, 7%. What will happen 10 years down the line? And should you allocate today in long-term bonds to compensate the future inflation trajectory? See, one should never do it in credit bonds. Like when you are investing in a A-rated company, which is giving 10%, 11%, 12%, don't take too long a tenor call in such kind of bonds. Limit the bond tenor to 2 years and at max 3 years. Because longer the horizon of the bond, greater is the credit risk. After all, you're giving money to a private company. It's not a government or sovereign guaranteed bond, right? And things can go wrong. Like one doesn't know what will happen 5 years, 10 years down the line. But if you've studied the company well, 2 साल में default तो नहीं होगा. The company's financials may worsen slightly, but unlikely the company will bankrupt. So hence, like when you're investing in private company bonds, restrict the tenor to 18 months, 24 months, at max 36 months. And don't worry about the inflation part, inflation trajectory, because when inflation was 9%, FD used to give 10% and bonds used to give 13, 14%. Now inflation is at 6%, FD is giving 7, bonds are giving 10%. If tomorrow inflation is, let's say, 3%, bank FD will give 4%, your bonds will give 6, 8%. So that real return which is there of 2 to 4% will always remain. So you need not like worry ki 10 saal baad inflation kya hoga, should I plan now? That in real terms, that 2 to 4% delta that a bond is giving, wo milta rahega. So once your bond matures after 2 years, you can reinvest. And there again, you will get 2 to 4% real returns.
Someone there, yeah.
Hi, Akshat this side. So I had a question I wrote down. So do you think the recent SEBI consultation paper on raising the minimum issue size of SDIs to 1 CR and raising the MMR to 10% would hamper your OBBP's ability to compete with debt mutual funds?
So thanks. I think that's a very good question. And then that's definitely a consultation paper where multiple views are going. And so SEBI has solicited that. So at least our view, we've been discussing and across the industry, we see that this is a great market. And definitely SEBI is also has solicited remarks there to promote that. That's the most important objective. So I think this will also take its own shape. At least we believe as for this to deepen, if the face value is lower, it definitely will help in terms of deepening this market, the SDA market. However, we should appreciate where the regulator is coming from. It is coming from the perspective of investor protection. So if one is putting a cap of, or say minimum slab of about 1 crore face value, it is from the protection perspective. So I'm sure with more issuances coming in, more acceptability, visibility, transparency coming into this, I'm sure there will be a roadmap wherein we can reduce the face value to enable much deeper participation in this market as well. But then the answer is very clear. You reduce the face value, there will be much more participation, and hence a scope for offering it to larger public.